Fannie Mae's former CEO is accused of being part of one of the largest accounting scandals in U.S. history. The mortgage lender's regulator says Franklin Raines knew Fannie was using flawed accounting to understate billions of dollars in losses.
It's a day of mergers and acquisitions on Wall Street with billions of dollars of deals now in play. In fact, 2006 has been a big year for M&A activity both here and abroad.
This woman has a tough challenge, keeping her home out of foreclosure. She's one of a growing number of Americans who are behind on their mortgages and unable to sell their properties. We look at the changing economics of American home ownership.
Also, the economy of Japan has been chugging along in recent months. Now there are concerns it could be heading for a derailment. We'll tell you why and what it could mean to the U.S.
I'm Susie Garrow.
And I'm Paul Kangas. This is Nightly Business Report for Monday, December 18th.
Nightly Business Report is made possible by
Is your nest egg in shape for retirement? Objective financial advice can help. A.G. Edwards, for more than 118 years, fully invested in our clients.
Franklin Templeton Investments, providing a unique perspective through the specialized investment expertise of Franklin Templeton Mutual Series and Fiduciary Trust. Franklin Templeton Investments, gain from our perspective.
This program was made possible by contributions to your PBS station from viewers like you. Thank you.
Good evening, everyone. The government today filed civil charges against 3 former executives of Fannie Mae in connection with the mortgage lender's massive $6 billion accounting scandal. The charges allege Fannie's former chairman and CEO Franklin Raines and 2 others deliberately mismanaged and manipulated its financial reports and kept those conditions going for 6 years. The Office of Federal Housing Enterprise Oversight, or OFAO, is seeking fines that could top $100 million. It also wants back more than $115 million in bonuses paid to the trio. Legal expert Steve Ryan says Raines' huge salary is a key issue in this case.
The $91 million in compensation that he drew and the very poor results for the corporation during the same period and their need to restate leave him in a position of having to defend his actions against a government that doesn't have to pay for its attorney's fees and can spend any amount of resources to try and take back from him the compensation that he was paid.
Raines and the other defendants, former CFO Timothy Howard and former controller Leanne Spencer, have all denied wrongdoing at Fannie Mae. Today, Raines' attorney claimed OFAO's director James Lockhart is biased and called for Lockhart to remove himself from the case.
Merger proposals worth $77 billion were announced around the world today. Topping today's list here in the U.S., Express Scripts launched a rival bid for Caremark RX. It's offering $26 billion in cash and stock for the pharmacy benefits manager. Caremark says while it'll review the new offer, it's still bound by the terms of an existing merger agreement with drugstore chain CVS. That $21 billion deal was inked last month. Several private equity deals also in the works. Biomet is going private in a deal valued at around $11 billion. The sale to a consortium including the Blackstone Group comes 10 months after the orthopedic device maker put itself on the block. Casino giant Harrah's Entertainment is nearing a deal to go private. Published reports say Harrah's will accept a $16.7 billion buyout from Apollo Management and Texas Pacific Group by tomorrow. Apollo Management is also in a deal to buy real estate services firm Realogy for $6.6 billion. Realogy owns realtors Coldwell Banker, Century 21, and Sotheby's International. Well, today's deals are helping to make 2006 the best year for M&A activity in 6 years. Experts attribute the merger mania to a strong economy and stock market. And as Suzanne Pratt reports, some believe next year could see even more corporate marriages.
Corporate America and its urge to merge spread more cheer on Wall Street today. Billions of dollars in new deals announced in the last few days helped push the total volume for this year to more than $1.4 trillion. According to Thomson Financial, 2006 will eclipse last year's M&A activity, and it's on track to rank second only to 2000 in total value of announced deals in the U.S. Private equity groups sitting on a mountain of cash from pension funds and wealthy individuals are behind about a quarter of this year's deals. Thomson Financial's Rich Peterson says a number of private equity funds are masters at raising capital.
Blackstone, Bain Capital, KKR, they've gathered enormous pools of money, something on the order of $12, $15 billion per fund. And actually, they're looking for targets. It's not in their interest to sit on that money.
Experts say what's unique this year is that foreign companies are also major participants in M&A. They attribute the surge in merger activity worldwide to modest company valuations and available credit. Lehman Brothers' Mark Schaefer says it's an ideal environment.
The credit markets are incredibly open, and interest rates are about historic lows. The public equity market is in very good shape. Economy's in good shape. So you've got public markets, economy, and as a result, people are more inclined to do transactions.
AT&T's proposed purchase of Bell South tops the list of biggest deals this year, followed by Blackstone's bid for equity office properties. Many experts believe the merger mania will extend into next year. They say conditions are very positive for a healthy jump in M&A activity in 2007.
Overall, we think 15 to 20% is about right. Now, this year it was higher. And if we're wrong, we think we're probably wrong that we're too conservative. We think there could be some upside in that percentage increase.
Many industries saw mergers in 2006. Telecommunications, financial services, and technology were just a few. Experts say because the deals are happening in most industries, that suggests the M&A trend is sustainable. Suzanne Pratt, Nightly Business Report, New York.
All that merger activity and a drop in oil prices gave stocks a nice opening boost. The Dow was up 40 points early on, while the Nasdaq gained 14. The rally lost its luster as some investors decided to take profits after last week's sizable gains. The Nasdaq led the way lower as the markets ended in the red. The Dow Industrial Average closed off exactly 4 1/4 at 12,441.27. Nasdaq down 21.63, ending at 2435.57. Standard & Poor's 500 index dropped 4.61 to 1422.48. Over in the bond market, the 10-year note rose 3/32 to par and 9/32, putting the yield at 4.59%.
The U.S. dollar fell slightly today against the euro and the Japanese yen on news that the U.S. trade deficit widened to a record in the last quarter and that American home builders are a bit more pessimistic about the housing market. This year, the U.S. dollar is down more than 10.5% against the euro and down 13% against the yen. Joining us now with some analysis and the outlook, Ashraf Lady, Chief Currency Analyst with CMC Markets. Hi, Ashraf.
Hello.
What would you say is the key factor that's weighing down the dollar these days?
Well, the main factor is that the level of growth in the Eurozone and in the UK is growing actually faster than that of the US in the third quarter and expected to do so in the first quarter. So that's something we have not seen in 5 or 6 years. But something that we have not seen since the life of the euro, since 1999, is actually the central banks in the Eurozone and in the UK are in the midst of raising interest rates while the United States, while the Fed is expected to cut rates in the short term. This divergence in interest rates has not been seen, and that's what's really weighing on the US dollar. And of course, with that comes a divergence level of growth. And also one more thing is that the central banks of Asia and of the Gulf countries are considering accumulating alternatives, more FX reserves that are alternatives to the US dollar.
All right, so let's talk a little bit more about that. If this trend continues, especially what you're talking about with the Federal Reserve, everybody believes that the Federal Reserve at some point is going to cut interest rates next year. If that does indeed happen, will we see a run on the dollar?
I do not think we're going to see a run on the dollar, because a run on the dollar would entail a fast rise in the currencies of Europe and of Japan. And these economies, as they are now in the midst of an economic recovery, they really cannot afford to kill off that recovery due to excessive strength in their currencies, which could weigh on exports. So I think that we could see further declines in the long term in the US dollar that are interrupted by short-term bouts of dollar increases like we have seen in the past 2 weeks.
So what does all of this mean for the stock market? What does this mean for corporate earnings? Is a dollar decline bad for corporate America and for the stock market?
It is good to the extent that it's a stable decline. It is good to the extent that, look, with the S&P, with the S&P firms at 25% of their earnings come from abroad. So therefore, they do gain from a weak dollar, and that's what U.S. investors gain from. And I think that, come Q1, you're going to hear more about the term of organic growth. That is level of earnings, excluding the foreign exchange effect, which is a positive. It would be a negative if the decline in the US dollar is so fast to the extent that it reduces the attraction to US dollar, in holding US dollar by foreign investors. Okay. That's when we would have a danger, but we are unlikely to see that.
All right. Well, thank you so much for your analysis. We appreciate it, Ashraf.
Thank you.
We've been speaking with Ashraf Lady, Chief Currency Analyst with CMC Markets.
A disturbing trend is emerging in home ownership these days, and for many people, that American dream is becoming a nightmare. New figures show a growing number of homeowners are having a tough time paying the mortgage, and delinquencies and foreclosures are on the rise. As Stephanie Du reports, rising mortgage rates and falling home values are taking their toll.
Fernande Clarizier bought her house just before Hurricane Wilma struck Florida last fall. She wiped out her savings repairing the damages and is now behind on her mortgage and facing foreclosure. The downturn in the South Florida real estate market makes it difficult for her to sell.
The offer that they give me is it's like I'm going to have to pay, because the offer that they give me is not enough to cover, everything that I owe the bank. They want to buy the house for less, and I'm still going to owe money.
The economics of home ownership have changed dramatically in the last year as interest rates have climbed higher and the rapid run-up in prices has disappeared. New figures show an increasing number of people are late on their mortgages or not paying them at all. That's especially true for people with poor credit. More than 13% of borrowers with subprime loans are delinquent. Nearly 4% are in foreclosure. Mortgage Bankers economist Doug Duncan says the increase is not surprising.
We've made a lot of adjustable interest rate loans over the last 3 years, and the Federal Reserve has been raising short-term rates, not in the most recent 4 months or so, but for a couple of years before that, the steady march upward in short-term rates. That meant we were going to see adjustments upward in payments for people with adjustable rate mortgages.
Many of these loans are known as 228 loans. Typically, they have an initial interest rate 2 or 3% above conventional mortgage loans. On average, they adjust 2.5% higher after 2 years. This fall, regulators told lenders to better qualify borrowers for these loans, but FDIC Chief Economist Richard Brown says it's unclear if that's happening.
It's hard to say if lenders are tightening up. Certainly in the last couple of years, we've seen a fairly permissive lending environment fueled by the appetite and the part of the credit market participants for mortgage-backed paper backed by subprime and low-doc mortgages.
The average debt-to-income ratio in the subprime market is now 41%. With higher interest rates, some buyers could be faced with 80% of their income going to pay the mortgage. Alan Fishbein is Director of Housing Policy for the Consumer Federation. He's concerned many borrowers believe banks won't lend them more than they can repay.
The market is shifted in recent years. Lenders used to be the gatekeepers of credit, and borrowers had to convince them to make them a loan. But the mortgage market's gotten very adept at pricing for risk.
Next year, $1 trillion in adjustable rate mortgages will reset. For subprime borrowers, that's certain to be a financial strain and could lead to even higher foreclosure rates. Stephanie Du, Nightly Business Report, Washington.
Now let's look at our stocks in the news tonight. Most active big board issue, Citigroup on 26.3 million shares, up $1.37. Merrill Lynch today upgraded it from neutral to buy. Then came GE with a 64-cent gain. CVS Corp down 51 cents. The company's buyout bid for Caremark was topped by Express Scripts by about 15%. Caremark's itself doing well, up $5.28. That deal from Express Scripts, about $30 in cash and $30 in stock, $60 total. Ford Motor down 5 cents. That was fifth in volume. Then we see Pfizer moving up 19 cents. ExxonMobil down $1.79. Oil prices down today. And also the Friedman Billings brokerage forecast lower crude oil prices in 2007. Downgraded Exxon from outperform to market perform and gave the same downgrade to some other oil-related issues like Hess, Holly, Murphy Oil, and Tesoro. All casualties today on that news. Then we see Realogy. You just heard about it. It's going to be, used to be called Sendent, and Apollo Management to acquire it for $30 a share in cash. AT&T down 19 cents. Of course, the company boosted its quarterly dividend a little Friday, but today FCC Commissioner Robert McDowell said he will not vote to break the agency's impasse over the purchase of Bell South. EMC, 6-cent loss. That was 10th in volume. Then we move on to Terex Corp, up $5.87. That stock to be added to the Standard & Poor's 500 index after the close tomorrow, replacing Navistar, which is being delisted. Then we see Elk Corp, the roofing products company, up $2.96. Another acquisition, this time by equity group, private equity group Carlyle. The price is $38 a share in cash. DynCorp International up $2.14. The U.S. Army awarded a 5-year, $4.6 billion linguistic contract to this company. On the other hand, L3 Communications lost out on that contract, and meanwhile Standard & Poor's downgraded it to just a hold, and the company cut earnings estimates. The Shaw Group up $2.62. It has been selected by the China State Nuclear Technology Company to provide engineering services on 4 new nuclear plants in China. The Brinks Company up $3.55. This week's Barron's Financial notes that a major investor may urge the company to sell part or all of itself. And then Weight Watchers rising $4.32. It began a modified Dutch tender offer for up to 8.3 million common shares at a price between $47 and $54. Google topped the active list, plummeting $17.50 on profit growth concerns. Some fear that it may stall. Apple Computer down $2.25, 30-cent drop in Microsoft. Cisco moved up 5 cents. Research in Motion a 51-cent gain, fifth in dollar volume. Intel, 12-cent loss. Oracle, 23-cent gain. Biomet up down 41 cents. As you heard, Blackstone's going to acquire it for $44 a share. Express Scripts itself up $1.31, and Qualcomm a 43-cent loss, 10th in volume. Joy Global, this is the mining equipment company. Big fourth quarter earnings, 71 cents up from 45 cents last year, and a nickel above the street estimate. Those are the stocks in the news tonight. Susie?
Paul, the economy of Japan has staged a dramatic comeback in recent years from the recession that dogged it through the 1990s. But now concern is growing again over the Asian nation's economy, this time about continuing weakness in private consumption. From Tokyo, Lucy Kraft reports.
A record-breaking economic recovery. Japan is cruising on its longest growth streak since World War II. 59 straight months of expansion and counting.
Exports to the United States and China and the restructuring of Japanese companies, along with a significant improvement in their debt situation, have created a long-lasting recovery.
Not since the 1960s, when Japan was in developing country mode, have the economy's vital signs stayed healthy for so long. Real estate prices up, corporate profits up, joblessness fading. The torpor of recent years seems a distant memory. But if the world's second biggest economy is smoking, why are consumers retreating?
It feels like the economy is just getting worse. My income is going down and taxes are going up.
I'm not just cutting frills. I've downgraded my whole lifestyle. Instead of spending $100, I try to spend only $80 or $90.
While the headline GDP numbers are rosy, consumers remain missing in action. Domestic demand accounts for over half of the economy here, and so depressed consumer sentiment has raised doubts about the strength of the recovery.
Economic growth is extremely lopsided. There should be more personal consumption. That is why it's called a recovery. It doesn't feel like a recovery.
The last time Japan saw a show-stopping economy in the late 1960s, household spending on luxuries like cars, TVs pushed growth to a searing more than 10% a year. But this time, the uptick is a more modest 2%.
In the past, exports and capital investment drove economic recoveries. So if companies revived, so did the larger economy. But this time, the corporate recovery is not trickling down to consumers. Incomes aren't rising, so even if people wanted to spend more, they can't.
Still, the government maintains there's no danger of a downturn. Some economists take small comfort in, of all things, a shrinking workforce.
Next year, as baby boomers start to retire and leave the workforce, labor will become tight, so incomes will rise a bit. It won't be huge, but there will be some improvement in household income and personal spending.
But unless Japanese consumers open their wallets again, observers say Japan's over-reliance on exports leaves it vulnerable to a slowdown overseas, particularly in the U.S.
Japan's unprecedented economic expansion is expected to keep stretching through the middle of 2007. But without additional measures such as higher productivity and better use of the female workforce, economists say Japan's economic growth will stay ho-hum. Lucy Kraft, Nightly Business Report, Tokyo.
Tomorrow, how saving money for your health care could give you money for other things as well.
Here's a look at what's happening tomorrow. The November reports on producer prices and housing starts come out, along with weekly retail sales. Also tomorrow, earnings from Circuit City, Morgan Stanley, and Palm. Tonight's commentator says while the relationship between the U.S. and China is economically important, it shouldn't be the only relationship on which we focus. Here's Glenn Hubbard, Dean of Columbia University's Business School and former chairman of the White House Council of Economic Advisors under President George W. Bush.
Treasury Secretary Paulson and a gaggle of U.S. officials have gone to China for a high-level Sino-U.S. dialogue on economic policy. The dialogue focuses on China's exchange rate policy and $200 billion current account surplus. The trip is important, though a focus on China's creaky financial system would be more on point for the Chinese and U.S. economies. The Secretary may want to consider the oil-rich Middle East, though, a cauldron of instability with a nearly $300 billion current account surplus and an exchange rate peg against the dollar that makes China's exchange rate movements seem more like the hare than the tortoise. Gulf economies are running a surplus of almost a third of GDP versus 8% for China. Overlooking the Middle East is a mistake. The dollar pegs in key Gulf states are slowing down adjustment to global imbalances. While China has allowed the yuan to appreciate against the dollar by about 7% this fall, Gulf economies have a firm currency peg. And weak local financial systems offer few opportunities to strengthen business formation and investment. While more attention to the Middle East would be welcome, Middle Eastern banking and currency reform will not be a cure-all for America's current account deficit, and the same can be said for China. But a rise in U.S. saving, combined with more domestic spending in oil exporters in China, is the recipe for success. I'm Glenn Hubbard.
And that's Nightly Business Report for Monday, December 18th. I'm Susie Guerra. Good night, everyone, and good night to you, Paul.
Good night, Susie. I'm Paul Kangas, wishing all of you the best of goodbye.
Nightly Business Report is made possible by
Franklin Templeton Investments. Our unique perspective helps us see domestic and international markets in a different light. Franklin Templeton Investments. Gain from our perspective.
And by A.G. Edwards.
This program was made possible by contributions to your PBS station from viewers like you. Thank you.
A pajamagram. Spoil your wife or girlfriend and give her what she really wants. We've got all the top brands of pajamas and lingerie. Over 100 styles, from comfy to sexy. A pajamagram is the perfect Christmas gift. She'll think of you every time she puts them on. Every pajamagram is delivered in a hat box she'll love, along with a lavender sachet, a gift card, and a Do Not Disturb sign, all free. We have great bath and body gifts too, all that spa stuff women just love. Call or shop online at pajamagrams.com. It only takes minutes, but she'll think you spent all month planning it. Overnight delivery is guaranteed, so call now or shop online at pajamagrams.com. It's a gift you'll both love.